Friends, welcome to our third session on setup and carry forward of losses session. In fact, we're covering the concept of aggregation of income and setup and carry forward of losses. So in this third session, we'll try to cover a few more aspects. Previous two sessions are already conducted and recorded video is available with you. Now I'm going to share the screen with you. Is it visible to you? Are you able to see the PPT slides? Yes or no?
Yes, sir.
Yeah. So the concept of aggregation of income we had covered. Then what is setup and what is carry forward of losses? That various kinds of setup, intersource, interhead, etc. we had covered earlier. Okay. So if you look at this slide, you know this slide also we had discussed. So we are talking about three kinds of adjustments in this slide under the head setup and carry forward of losses. One is intersource adjustment. But when talking about intersource adjustment, we have seen there are four exceptions to that. One is loss from speculation business, then long-term capital loss, then loss from some specified businesses which are specified under Section 35 AD of Income Tax Act 1961. Then loss from the activity of owning and maintaining of resources. These are the exceptions for intersource setup. Okay. These exceptions were discussed in detail. Next, I'll take you to the interhead adjustments exceptions. Some problems also were solved. Yeah. Now, coming to the next part is about interhead adjustments. So when you talk about interhead adjustments, here also we have seen various exceptions. Four kinds of exceptions we had seen. One is loss under the head capital gain. We know that loss cannot be set off against income from any other head. The loss from house property, it can be set off only to the extent of 2 lakh rupees. We know that thing also. Then one more exception, that loss under the head PGBP cannot be set off against salaries. Then also we know speculation loss from specified businesses mentioned under Section 35 AD, are losses from the activities of owning and maintaining resources. They also cannot be set off under interhead adjustment. These are the exceptions. So here we had seen some exceptions. I showed you just now 4 exceptions. Here also I showed you 4 exceptions. Now last part is carry forward and set up of brought forward losses. There also we'll be seeing around 7 exceptions. Let me show you that thing. And all these points we have discussed in detail. These are certain exercises we had done. In the previous class, last part, we are discussing about losses from the activity of owning and maintaining resources. We're talking about carry forward of that losses. Yeah, in that context, we had discussed that Section 74A3, that the losses incurred by the assessee from the activity of owning and maintaining resources cannot be set off against the income from any other source other than the activity of owning and maintaining resources. Such loss can be carried forward for a maximum period of 4 assessment years, being set off against the income from the activity of owning and maintaining resources. That was the last concept we are discussing in our previous classes. So losses which is generated from the activity of owning and maintaining resources can only be set off against similar activity. Okay. And that can be carried forward for how many assessment years?
4 assessment years.
4 assessment years. Okay, that concept we had discussed. Okay, what is the meaning of loss? I had not explained you at that point of time. Let us quickly understand what is the meaning of loss as regards to owning and maintaining of resources. If there is no income from that activity, then the entire revenue expenditure incurred for this activity is the loss. Okay, if there is no income, means income by way of stake money. Stake money means prize money. No prize money is received, then entire expenditure incurred, that is the loss. In case there is some prize money, then we have to see how much of the revenue expenditure is covered by prize money, and the extra amount is the loss. This is how one can compute what is the accumulated loss in the activity of owning and maintaining resources. Did you understand this?
Yes, sir.
Okay. Now, I was talking about this third exception, that carry forward and brought forward of losses. There are 7 exceptions. So let us read it one by one. Okay, setup and carry forward of losses. Inter-source setup exceptions, I had already shown you 4 exceptions. Interhead adjustment, 4 exceptions we have seen here. Carry forward of losses, these 7 exceptions you have to remember. Okay, I'll request some of you to read these exceptions one by one. First one.
Unabsorbed loss from house property can be carried forward for maximum 8 assessment years for set off against income from house property.
If there is a house property loss, that can be carried forward for 8 assessment years, and that can be set off against only from the income which is generated from house property. Second point.
Unabsorbed business loss can be carried forward for maximum 8 assessment years or set off against profits and gains from business or property.
Similar kind of provision. If there is a business loss, that also can be carried for 8 assessment years and can be set up against PGBP. Now, point number 3 is slightly different. Please read third point.
Loss from speculation business can be carried forward for maximum 4 assessment years or set off against income from speculation business.
Yeah, this is different in the sense you have to remember that it is not 8 assessment years. For how many assessment years it can be carried forward?
4.
4 assessment years. And it can be set off only against speculation business profit. Right? Now, fourth exception.
Loss from specified business under section 3580 can be carried forward for indefinite period or set off against profit from any specified business.
That also we have discussed. If there is a specified business and there has been a loss, it can be carried forward for indefinite period. There is no limit. But that can be set up only against the profits which are generated from specified businesses. Not necessarily similar kind of specified business, not necessarily the same specified business, but from maybe from other specified businesses. We have discussed that point. You have to keep that thing in mind. Now, next exception.
Long-term capital loss can be carried forward for maximum 8 assessment years for set off against long-term capital.
Yes, so this we have discussed several times, that long-term capital loss can be carried forward for 8 assessment years, but can be set up only against long-term capital gain. Now, next point.
Short-term capital loss can be carried forward for maximum 8 assessment years or set off against capital gains.
Set up against capital gain means any capital gain. Short-term capital gain can be carried for 8 assessment years, and it can be set up against maybe long-term capital gain, maybe short-term capital gain. Okay. Now, last point.
Loss from the activity of owning and maintaining race horses can be carried forward for maximum 4 assessment years or set off against income from the activity of owning and maintaining
Racehorse. This concept also we had discussed just now. It can be carried forward for 4 assessment years. So, friends, let us solve one more question, one more example. In fact, let us see. Very simple one. We will be able to do it. Okay. Again, some of you please read this example. We'll be solving it. You may take a piece of paper and pen. We'll try to solve it. Very simple question. You'll be able to do it. Please read this question first.
Mr. D has the following income
previous year.
for the previous year 2020 to 21. Income from the activity of owning and maintaining the race horses 75,000.
Yeah.
Income from textile business 85,000. Brought forward textile business loss 50,000. Brought forward loss from the activity of owning and maintaining the race horses for assessment year 2018 to 2019 96,000.
Okay. So now you see there is a brought forward losses of the business of owning and maintaining resources. How much it is? 96,000. You know, this loss can only be set up against which profit? Can it be set off this 96,000? Can it be set off against any profit, any income?
Yes, sir. Against activities of owning and maintaining resources only.
Okay, so here there is 96,000. This can be set up against this 75,000. Okay, so that means the balance amount will be carried forward. Okay, income is only 75,000 under similar activity, but we have a loss of 96,000. So balance can be carried forward only to the extent of 75,000 that can be set up. Then what about this business loss? Income from textile business is there 85,000. Then brought forward textile loss is 50,000.
So that will again be put off against the income from textile business only.
Very good. Now you have understood the concept. Now we'll do this thing. You see here I am showing you the solution. Okay, just have a look. Don't worry, even if you are not able to note it down, don't worry. Recorded video will be available in our channel. So you can see it, income from the activity of owning and maintaining resources. How much? 75,000. Brought forward losses 96,000. So remaining 21,000 that will be carried forward to the next assessment year since we couldn't set up. But under textile business, there was a income of 85,000 and brought forward losses of 50,000. So remaining 35,000 will be the tax total income and on which tax has to be paid. Did you understand this?
Yes, sir.
Yes.
Thank you. So if you want, you can have a look. Okay. Now, the exceptions that all I told you so far, you see, first is inter-source setup. You see 4 exceptions I showed you. Then inter-head setup. Again 4 exceptions I showed you. That carry forward 7 exceptions I showed you. Right, these things we have already seen. Now everything is there, and these exceptions are very important for you. Okay, if you want, once again, I will insist since it is important, quickly go through it, have a comprehensive view. Okay, can anyone of you explain this? Is it readable to you? Of course, font is little small. Are you able to read it?
Yes, sir.
Okay, can you explain it in a very summary form? In a very summarized way.
Intersource losses can be set off against each other, except for in some situations that are one, loss from speculative business, which can only be set off against income from speculative business.
Good.
And the second one, the loss from long-term capital gains, which can only be set off against long-term capital gains, but in situation of short-term capital gain, it can be set off against both short-term and long-term capital gains. The
Okay.
third exception is loss from specified business. Again, the exception says that the loss from specified business under section 35 AD can be set off only against income from the specified businesses.
Yeah.
The fourth exception of intersource adjustment is for loss from the activity of owning and maintaining race horses, which can only be set off against income from the activity of owning and maintaining race horses.
Very good. So these are, you have to remember these 4 exceptions so far as inter-source setup is concerned. Once inter-source is over, there again inter-head. Here also 4 exceptions you have to remember. But when coming to carry forward, there are 7 exceptions. Right? Interhead. Now quickly tell me the exceptions.
In interhead adjustment, again there are 4 exceptions. First one is the loss under the head of profits and gains of business or profession. Uh, this exception says that the loss from PGVP cannot be set off against income from the head of salaries, but
Salaries.
be set off against the other heads of income.
Yes.
The second one says that the loss under the head capital gains cannot be set off against income from any other head, but the loss from the other heads can be set off against capital gains, except for when it's long-term capital. Sorry. The from other heads can be set off against the income from capital gains. The third one says speculation loss or loss from specified business under section 35 AD and loss from the activity of owning and maintaining race horses cannot be set off against any other head of income. And the last exception says that the loss from house property can be set off against any other head of income for up to a value of rupees 2 lakhs. And further that cannot be, which it will have to be carried off, and then it can be set off against only the head of income from house property.
Very good. Now coming to carry forward and set off brought forwarded losses. So unobserved loss from house property can be carried forward max for 8 years, but it can be set up only against house property. Unobserved business loss can be carried forward max up to 8 assessment years, but it can be set up against PGBP. Loss from speculation business can be carried forward for 4 assessment years, can be set up against speculation income. Loss from 35 AD business can be carried forward indefinitely, but it can be set up against specified businesses income. Now, long-term capital loss can be carried forward max 8 years, can be set up against long-term capital gain. Short-term capital gain can be carried forward max 8 years, can be set up against both long-term and short-term capital gain. And loss from the activity of owning and maintaining resources can be carried forward max for 4 years, can be set up against income generated from similar business. Okay, this is the summary of all the exceptions which are important for us. Now friends, now we are entering to learn one more related topic, that is order of setup. Okay, so when there are so many things which are brought forward, how can we be able to set up? This entire things are dealt with. We have to see, remember this sequence. Okay, so we have to keep in mind the provisions of section 72(2), where it gives us some idea that how we'll be able to, in which order we'll be able to set up. So the first priority is that you see what is to be charged from the income, current year's depreciation. Okay, first whatever is income is there, current year's depreciation has to be charged. Next is current year's capital expenditure on scientific research and current year expenditure on family planning. Okay, so if you already have studied the chapter PGBP, you know these are allowed expenditures. So depreciation will be allowed, then scientific research expenditure and family planning expenditure to the extent it is allowed, that also has to be done. After that, what comes next is the brought forward loss of the PGBP. If there is some brought forward loss, that will be taken care of. So after loss, next thing comes as unobserved depreciation. Okay, so first brought forward loss, then unobserved depreciation. If the previous year depreciation has not been observed, that has to be dealt now. Then unobserved capital expenditure of scientific research. Okay, if there is some scientific research unobserved expenditure is there, that will come to next. Then unobserved expenditure of family planning. Okay, so this is the order in which the losses or unobserved expenditures can be set off. Okay, here priority you have to remember on brought forward capital loss. So brought forward business loss has got a priority over unobserved depreciation. Okay, did you understand this sequence?
Yes, sir.
Okay, and you must be knowing that unobserved depreciation has got no time limit. Indefinitely it can be carried forward. Just for information at this stage, let me tell you that. Okay, same also expenditure on scientific research, that also can be indefinitely carried forward. But the family planning expenditure, there is a limit. Up to 4 assessment years it can be carried forward. But sequence you have to remember right now. Did you understand?
Yes.
Okay, friends. Now here is one more example, one more illustration. Let us see how to solve it. Pick up your pen and paper, just key points you can see. So this is a situation where you see there is income from salaries. Computed means after everything, after all adjustment, it comes to 1,50,000 rupees. Speculation business income is 60,000 rupees. Loss from speculation business 40,000. Short-term capital gain 80,000. Long-term capital loss 30,000. Winning from lotteries 20,000. Now you have to compute the taxable. Are you seeing what are the things which can be set up? Is there any possibility of setup?
Yes, sir.
Yeah, tell me.
So loss from non-speculation business can be set up against income from
Speculation.
speculation.
Okay, good. So if you solve this particular question, you see answer will be like this. Salary income 1,50,000, entire amount, which will be considered as a taxable income. Speculation business, there is an income of 60,000, there is a loss 40,000, so remaining 20,000 rupees will be taxable. Short-term capital gain will be taxable 80,000 rupees. Winning from lotteries will also be taxable. Okay, what we couldn't adjust is, you see, long-term capital loss. There is a loss, but we couldn't set up because this cannot be set up against all these incomes which are available. Okay, did you understand the situation? Okay, will you be able to do a similar question? So friends, you have to keep in mind all the exceptions that has been taught to you that will help you to solve the question. Okay, here one more issue now we'll be covering. You see, this is about the concept of casual income. You must have heard about this, what is casual income. But so far as the setup and carry forward of losses is concerned, we have to understand one more thing. No loss can be set up against casual income. Okay, if there is some loss that cannot be set up against casual income means examples I can give you, like winning from lotteries, crossword, puzzles, races, including horse race, card game, or any other game or any sort of gambling. Okay, all these things are the examples of casual income, and no loss can be set up against them. And also, no expenses can be claimed for casual income. So this concept you have to keep it in mind. Okay, friends, is it clear to you? Yes or no?
Yes, sir.
Okay, good. Now, so many concepts we have covered. So far, we have covered broadly 12 concepts. Now, under 13th concept, we have to deal with three aspects. One you can see is about amalgamation. Second is demerger. Third one is reorganization of the business. I think if you are familiar with these terms, you understand what is amalgamation. When I talk about amalgamation, what is exactly means? Two companies are merged. Okay, technically merger, amalgamation, etc. Same thing from income tax point of view. There are differences between acquisition, merger, and amalgamation, but here we'll consider they're same because two companies are two entities are merged and a new entity is formed. Okay, so that is one thing. When you talk about demerger, that means one existing company is split into multiple entities. That is an example of demergers. If amalgamation can be compared with a corporate marriage, then demerger is a kind of divorce. Okay, there is one company now that is split into two different companies. That is an example of demerger. Okay, and there might be corporate reconstructions, like one company is, let us say, one partnership firm is acquired by a company. So that possibilities are also there. How to deal with this carry forwarded losses in these situations? That is what we are going to learn now. Okay, so these are the sections. Section 72A broadly will be dealing about. Okay, and here also these three sections will be talking at a very surface level. Will not go deep into that. Okay, so now we'll be discussing about the few concepts which are covered under section 72A, which deals with accumulated loss and unobserved depreciation allowance in case of amalgamation, demerger, and reorganization of business. First, let us see this carry forward and setup of accumulated losses and unobserved depreciation in case of amalgamation. Friends, now you have to keep in mind this particular situation. This provision says where there is an amalgamation of a company owning an industrial undertaking. You have to keep in the mind it should be an industrial undertaking which is owned by a company, or a ship, or a hotel. Okay, or if it is an amalgamation of a banking company. Okay, so that means I'm talking about four situations. One is there should be a company. The company must own a industrial undertaking. Second case, company must own a ship. Second is company must own a hotel. Right? Or the fourth situation is that if it is a amalgamation of a banking company. Okay, understood. In these kind of situations, the accumulated loss or the unobserved depreciation of the amalgamating company, that means the old company which is going to be amalgamated, shall be deemed to be the loss or depreciation allowance of the amalgamated company. That means old companies accumulated losses and unobserved depreciation shall be deemed to be the accumulated losses and absorption of a new company. That is the amalgamated company. When for the previous year in which amalgamation was effected, let us say amalgamation was effected in the previous year 2021, then all these accumulated losses, unobserved depreciation, shall be treated as the accumulated losses and unobserved depreciation of the previous year 2020. Is it okay? Did you understand?
Yes, sir.
Okay. Once you know it is the accumulated losses of depreciation, unobserved depreciation of this previous year, then all other provisions shall be applied just like that. All other provisions of Income Tax Act shall be applied. Okay. Right? Understood?
Yes, sir.
Okay. All other provisions shall apply means, suppose now this is the loss of that previous year. Now let us say there is a time limit of 8 years. Then further 8 years is available to you. You can still carry forward. Okay. Understood? Are you getting my
Yes, sir.
point? Getting my point? Okay. So here you have to focus on this point. Yeah, shall be deemed to be the loss, or as the case may be, allowances or depreciation of the amalgamated company for the previous year in which amalgamation was effected. So it is the loss for the previous year in which amalgamation is effected. That means if the loss is about to expire, then you got a fresh life of another 8 years. You can still carry forward. Are you getting my point? So that is the advantage. But to avail that advantage, there are certain conditions. Okay, advantage is that, did you find out, did you understand what is the advantage? Are you getting me?
Yes, sir.
Okay. So what is the advantage? Are you able to recognize the advantage? Advantage is that, let us say there was a loss in a company which is about to expire. That means it is at the 7th year. There was no profit, so it couldn't set up. But if that company gets amalgamated with another company, then what is the advantage? We got a fresh life, because that loss will be treated as the loss of the previous year in which amalgamation is effected. Okay. Okay. Now let us continue. But to avail that benefit, what are the conditions that has to be complied? Let us have a look at this. First of all, let us see what are the conditions that should be there for the amalgamating company. The amalgamating company must have been engaged in the business. Business means, you know what kind of business we're talking about. Maybe shipping business, maybe banking business, maybe industrial undertaking, so forth, in which the accumulated loss occurred or depreciation observed for 3 or more years. The business should have been at least more than 3 years. Okay, has held continuously as in the date of amalgamation at least 3/4 of the book value of the fixed assets held by it for 2 years prior to the date of amalgamation. So that means at least 3/4 of the assets which the company is holding must be holding it for at least 2 years, 2 years before, 2 years prior to the date of amalgamation. So must be holding the asset for 2 years, and the business must be there for 3 or more years. So these are the conditions for the amalgamating company which needs to be complied with. Understood? And there are certain conditions for the amalgamated companies. First of all, the amalgamated company should hold continuously for minimum a period of 5 years from the date of amalgamation at least 3/4 of the book value of the fixed asset. It should not happen that the amalgamated company acquired the company, after that it started disposing of its assets. No, it must hold the assets for at least 5 years. 3/4 the assets must be held. And it must continue the business of the amalgamating company for a minimum period of 5 years. Business also should have been continued for 5 years. And it may be certain other conditions may be prescribed. So that conditions also needs to be complied. So amalgamating company has to comply certain conditions. Amalgamated company has to comply certain conditions. Then only the loss can get a fresh life. Okay. Is it clear to you up to this? Well,
Yes.
friends. Okay, friends. Now, the next I told you, next you have to see what will happen if the conditions are not satisfied. Let us say amalgamating company didn't carry out the business for 5 years. Then the loss which has been carried forward shall be deemed to be the income of the amalgamated company and chargeable to the tax in the year in which conditions are not complied with. If a particular year conditions are not complied with, then the loss will be again taxable. Okay. Okay, so this point you have to keep in mind. Now, we'll now deal with one more situation. Amalgamation part is over. What will happen in case of demerger? In case of demerger, as you know, a company is split into maybe multiple companies. So here in this case, what will happen? The accumulated loss and allowances of depreciation of the demerged companies shall where such loss or unabsorbed depreciation is directly relatable to the undertaking. Okay, undertaking means, let us say there is a company who are doing two different businesses. One is garment business, second is cement business. Okay, or one is, let me take a different example. One is software business, next is cement business. And they split into two different companies. Software, one company, cement, one more company. And if the accumulated losses are relatable to an undertaking, that means that is a cement sector, accumulated losses is there. It should be transferred to the resulting company who deals with cement. Okay. If the loss is related to, let us say, software, then it should be transferred to the resulting company which deals with software. Now, one company is split into two different companies. Then this is how things will be dealt with. Okay. Where the loss or unabsorbed appreciation is directly relatable to the undertaking, transferred to the resulting company, be allowed to be carried forward and set off in the hands of the resulting. When it is relatable, then one can easily do it. Okay, when it is not relatable, so there is a joint loss, what can happen? Then this loss, that is unabsorbed depreciation or brought forward loss, can be distributed in some proportion. In which proportion? In the same proportion in which the assets of the undertaking have been retained by the demerged company and transferred to the resulting company. The way assets are distributed, in the same proportion, the loss will also be distributed. Okay. Are you getting this point?
Yes.
Okay. Now, one more point we'll see. This is about reorganization of the business. When the business is getting reorganized, how to deal with this unabsorbed depreciation and accumulated losses. So, first we'll see. When the farm is succeeded by a company, that means there is a farm, maybe a partnership farm, or maybe it is a proprietorship farm. It is succeeded by a company. That means company is taking over or acquiring the business of it. Or a proprietor has started a business, later on it converted into a company. In that kind of situation, we will call it as the reorganization of the business. In that situation, the accumulated loss and unabsorbed depreciation of the predecessor farm or the proprietor concerned, as the case may be, shall be deemed to be the loss and allowance for the allowances for depreciation for the successor company. That means whatever was the loss, whatever was the unabsorbed depreciation, that shall be deemed to the unabsorbed depreciation or loss of the successor company. That means the new company which is formed. Okay, and for the purpose of previous year, in which business organization is effective. Okay, it will be deemed to the unabsorbed depreciation loss for the previous year in which the reorganization is effective. After that, remaining provisions of the law will apply. Okay. Did you understand? And you have to keep in mind one more thing. If the reorganization relates to a situation where a private company or unlisted company is succeeded by a limited liability partnership, then the unabsorbed depreciation and accumulated loss shall be deemed to be the loss or allowance of depreciation of the successor limited liability partnership. So if the private limited company or unlisted public company is converted into LLP, then also that loss or unabsorbed depreciation shall be deemed to be the unabsorbed depreciation or loss of the successor. That the successor will be holding. Okay, what is the consequences if the conditions are not filled out, complied with? We have talked about that thing earlier. Similar concept is also applicable here. One more concept quickly let me cover it. That is scheme of amalgamation of banking company. If a banking company is getting amalgamated under scheme of amalgamation, right, then the Accumulated loss and unobserved depreciation of such banking company shall be deemed to be the loss or unobserved depreciation. Okay, for the previous year in which scheme of amalgamation was brought into force. Okay, that means it will deem to be the unobserved depreciation or accumulated losses of the new banking company or the amalgamated company. That concept you have to keep. Okay, these are the three things: amalgamation, demerger, and business reorganization we discussed. Okay, now few more concepts are still there. Let us under the fourth concept, 14th concept, we are going to learn about what will happen in there is a change in constitution of firm. Okay, now we'll be learning the provisions of section 78. In case there is a change in the constitution of the firm is not entitled to carry forward and set up so much of the loss proportionate to the share of the retired or deceased partner as it exceeds his share of profit. Suppose there is a change in the constitution of the firm, meaning one partner is retired or one partner is passed on. Okay, his net loss, that means whatever is the loss attributable to him after adjusting the profits, that cannot be carried forward by the new firm. Understood? So proportionally that has to find out that loss which is relatable to the retiring partner cannot be carried forward to the reconstituted firm. Okay, did you understand?
Yes, sir.
Now, one more point. When the business or profession is succeeded by another person, let's say someone has taken over the business, the brought forward losses of the predecessor can be set off against the income earned by the predecessor before the successor. Okay, that means if before the successor it can be set off, but it cannot be carried forward. Okay, so if business is succeeded by some other person, if there is some brought forward losses, so it can be set off. It can be set off against the income earned by the predecessor before success. Before succession happens, whatever income is there, that can be set up. But the remaining loss, that cannot be carried. The successor is not entitled to carry forward the losses sustained by the predecessor and set them off. Successor cannot carry forward that. Okay, you can only set off prior to the date of success. Understood? Did you understand?
Yes, sir.
Okay. Suppose you have a business, you sold it to someone. Okay, he cannot carry forward your losses. Okay, he can set off if whatever is the income is there till the date of succession. He can set off against that, but he cannot carry forward. But there are certain exceptions where it can be carried forward. What is that exception? If the succession is by inheritance. Okay, suppose father passed away, business is getting transferred to the son, then it is possible. Okay, if succession is by inheritance, the heir at law, that is legal heir, is entitled to carry forward and set up the business losses of the predecessor. Understood this question? So that is an exception. Otherwise, it cannot be carried forward. Now, let us quickly learn some of the provisions relating to companies in which public are not substantially interested. Meaning we are talking about private sector, private company or closely held company. Right. The losses of the companies in which public are not substantially interested can be carried forward and set off only if the following conditions are satisfied. What are the conditions you have to see? The shares of the company carrying not less than 51% of the voting power were beneficially held by the same person on the last day of the previous year in which loss was incurred, and also on the last day of the previous year in which brought forward losses is to be adjusted. Let us say last year there was a brought forward loss, and this year there is an income that needs to be asked, that needs to be adjusted. Okay, in the both the days, that means last date of the previous year when loss was incurred and last date of the previous year when income is earned, you have to see who are the people who are holding share, where the shareholders. Not less than 51% of the voting power should have been changed. Did you understand? That means not less than 51% of the voting power should be continued to be the shareholders. If there is a change, that is change in shareholding beyond 51%. Okay, not less than 51% means 51% or more. Okay, if up to 51% shareholding has been changed, then loss cannot be carried. That means almost ownership is changed, it's a different company now. Okay, this provision is applicable to the companies in which public are not substantially interested. So beneficial ownership of the share should not have been changed beyond 51%. Did you understand this concept?
Yes.
Okay. But
Voting power cannot exceed beyond 51%.
sorry, please repeat your question.
The voting power cannot exceed 51%.
Voting power cannot exceed beyond 51%. Now, what is that exactly is the question?
Like whatever is the shareholding, like 51%, it can also exceed. Like if it is there, like supposing a person holds 70% of the shareholding, then
That the same person should be continuing as the shareholders in the year in which income is earned. Now,
okay.
did you understand? Let me then explain you
Yes,
once.
sir.
Let us see. Let us say in this previous year there is a loss. Okay. And 2021 there is a profit. You want to carry forward and set up it. Is it clear?
Yes, sir.
Okay. Now we have to see what is the shareholding here. You have to see how many people are the shareholders. If let us say some people are the shareholders, and here are also some people are shareholders. You have to see at least majority of the shareholders must be continuing as majority. That means at least 51% of the shareholders should be same. There might be change in shareholding. That means new shareholders might have come. Some people might have sold their shares, but at least 51% of the shareholders should be same. Okay, then only you can say it is almost the same company. Otherwise, there is a loss of a one company. Let us say they disposed of all the, let us say only 10% shareholders remaining, 90% shares are sold to different person. Okay, so there is a possibility that this is, or it gives an indication that this is almost a new company. All the shareholders are changed. Okay, so this is actually purposefully it has been done. There is a concept which is called as the loss trafficking. Okay, some people may use it as a tax avoidance tool. They'll incur some loss and change the shareholding. That loss will be transferred to a different company where shareholders are different. Okay, in order to discourage that thing, in order to frustrate that kind of tax planning, so this provision is there. So at least 51%, that is majority of the shareholders must be continuing there.
So that means that 51% majority has to be maintained. They have to be the same party.
Yeah, 51% should be maintained in both the years. In the last day of the previous year in which loss was incurred and the last day of the previous year in which profit is going to be set up.
Okay, thank you, sir.
Okay. Okay. But are you able to see the slide? No. Just a minute. Let me. But when I told you this thing, there are certain exceptions to that. Just a minute. Let me share the files. I told you 51% of the shareholding must be continued. Then only setup is possible. But setup will not be denied in case incidentally shareholding has been changed because of death of a shareholder. If shareholder has been died and because of that thing, it has been changed. Shareholding has been changed. Then still benefit will be continued. That means one will be able to set up. Or that is one situation, one exception is death. Second situation is that if it is transferred as a gift to any relative of the shareholders, let us say husband has transferred the shares to the wife, husband or wife are relatives. So in that, and that too by way of gift, then also even if shareholders are not same, but still loss can be carried forward. Okay, two exceptions I told you. One more exception is also there. That is, in case there is a change in shareholding of an Indian company which is a subsidiary of the foreign company, Indian company which is a subsidiary of a company, foreign company, and this change is happening as a result of amalgamation or demerger of a foreign company, subject to conditions that 51% of the shareholders of the amalgamating company or demerged foreign company will continue. So this is one more situation in which also setup and carry forward is allowed even if shareholding is not the same. Okay, but otherwise you have to remember that condition that at least 50% of the shareholders will be continued as the shareholders of the undertaking, shareholders of the company. Okay. Now, friends, one more important concept, that is carry forward and setup of losses in case of eligible startups. Okay, section 79B we have to cover right now. So the startup companies concept. Right. So here the condition is that the company should not be a company, or you can say the assessee company in which public are not substantially interested. Okay, first of all, we have to see it should be a company in which public are not substantially interested. It should be a closely held company, private company. Then it should be an eligible startup as referred under section 80 IAC. It should be a startup company. Then the loss incurred by the company during the period of 7 years, starting from the year in which company is incurred. If the loss is incurred during 7 years, starting from the year in which company was incorporated, we have to see, and this loss pertains to these 7 years. If the above conditions are satisfied, then the brought forward loss can be set off against current year's income only if the shareholders of the company, okay, on the last day of the previous year in which loss was incurred, continue to be the shareholders on the last day of the current year. If the shareholders are same, then past 7 years loss can be carried forward and set up against current year's company. Understood? This is applicable for startup company. But here also, as I told you, shareholders will be same, but there are exceptions. Exception is that where shareholders are different due to death of a shareholders or due to gifting of shares by shareholders to his or her relative. Okay, so these are the exceptions. Okay, and this condition also need not apply to unobserved depreciation, unobserved capital expenditure on scientific research. These things can be carried forward even if conditions are not compliant. Okay, and this is also not applicable when the assessee is a subsidiary of a foreign company and and the foreign holding company is amalgamated or merged. In that kind of situation also, this condition need not be compliant, but still it can be carried forward. Okay, so broadly you have to remember the past 7 years losses can be carried forward and can be set off provided shareholders are same, and it should be an eligible startup company in which public is not substantially interested. Okay, is it clear to you? Okay, thank you. Now, friends,
Yes, sir.
good. Now, one more concept, that is submission of return from losses. We need to quickly cover it. Section 80. When loss is needed to be set up, there is a requirement in many situations that return needs to be filed. As for Section 80, business loss, speculation business loss, loss from specified businesses, then loss under the head capital gain, and loss from the activity of owning and maintaining resources. Okay, which has not been determined in pursuance of return filed. The return has not been filed for these losses. Return filed under Section 139(3) cannot be carried forward. That means these losses cannot be carried forward unless the return, unless loss has been determined by way of filing of the return. Okay, so return filing is necessary to carry forward this loss, carry forward these kind of losses. Okay, and that too, that return should be filed within the time limit which is allowed under Section 139(1). Within the due date, it should have been filed. But however, for other losses, for example, losses from house property, okay, or unobserved depreciation can be carried forward even if return has not been filed in time. Okay, friends, did you understand this concept? Okay,
Yes, sir.
with this, we covered this chapter, setup and carry forward of losses. If you have any query, then right now feel free to ask me immediately. So we'll try to address that thing. No query, hopefully. So at this stage, thank you very, very much. Thanks a lot.